Okay, this video is on section 3.3, the final section in chapter 3. And we're going to just talk about a few more types of transactions, and those are going to be the ones that affect revenue, expenses, and withdrawals by the owner. So revenue and expenses, if you've had a business class, I feel like you know the answer to this, but just to run through it again. Revenue is income earned from the sales of goods or services. It could be fees earned for services performed. It could be cash received for selling of merchandise. Whatever that might be, whatever type of business you have, it's the way you make your money. Revenue increases the owner's equity because it increases the assets. So you've either sold something on account for cash, so the left side is going to go up, and revenue is going to increase the right side by giving the owner more value in the business. Both revenue and investments by the owner increase owner's equity, but they're really different transactions. So revenue is income from the sale of goods or services, and it's very different from an investment, where investment the owner is contributing. So you just need to make sure that you don't confuse the two. Very, very different. In order to make revenue, a business has to incur an expense, and it might be small, but it might also be large. So an expense is the cost of doing whatever they do for their revenue. So the cost of products or services used to operate the business. We talked a little bit about this in class. It could be rent, it could be utilities, it could be advertising, it could be salaries, it could be a miscellaneous expense. There's tons of different classifications of expenses, but it is the cost that you incurred to make your revenue. Expenses are opposite of revenue. They decrease owner's equity because they decrease the assets of the business, or they could increase liabilities. The effect of revenue expenses are kind of summarized below here. So revenue increases assets, increases owner's equity. Expenses decrease asset, and they decrease owner's equity. So looking at I think three more business transactions quickly. So we received a check for $1,200 from a customer for delivery service. So this is the way we earn our money. Okay, so this is a revenue transaction, and we received a check. So I told you in the last video, check is equal to cash. So the two accounts that are affected are cash and the owner's equity or capital account. Classifying them, cash is an asset, Krista Vargas is owner's equity. Cash is going up. We received a check, and since it's a revenue transaction, capital is going up, or owner's equity. And so how does our equation stay in balance here? So here we have the increase to cash on the left side of the equation. On the right side of the equation, we have the capital or owner's equity account going up. The next one, transaction 9, is a transaction that involves an expense. So Zip wrote a check for $700 to pay for rent for the month. All right. So if we wrote a check, check is equal to cash. So cash is going to be affected. And then expenses decrease owner's equity or capital. So the capital account is going to be affected. The capital, I said those two, sorry. Capital is owner's equity and cash is an asset. By writing the check, our cash is going to decrease, and then expenses decrease owner's equity or capital, so the capital account is going to decrease. Looking at how it stayed in balance, cash went down on the left side of the equation, owner's equity or capital went down on the right side of the equation. So the final part in here is that there's a fourth thing that affects capital, and that is a withdrawal by the owner. So If a business earns revenue, the owner is able to take out money from the business, and it decreases their equity in the business, but they're taking it out for their personal use. And withdrawals decrease assets because they're taking cash, and it decreases owner's equity because he's losing part of his or her equity. Really important, though, that you don't look at them as the same as an expense. They act the same in the equation. They both decrease assets and they decrease owner's equity, but they're not the same thing. An expense is a cost of doing business. A withdrawal never has to happen. Of course, it does happen, but they're different. So our owner, Krista Vargas, withdrew $500 from the business for her personal use. The two accounts that are affected are capital and cash. Capital is owner's equity. Cash is an asset. Capital is going to go down because her equity in the account, in the business is down, and cash is down because we took $500 from there. So if we look at this, we have $500 on the left side decreasing, and on the right side of the equation, capital, we have $500 decreasing. So our equation remains in balance. This is kind of a summary of what we did in the 10 transactions. I will post one final video with an example about how to do the problems in Excel.